We're going to start today's sessions with a highlight, I think. My name is Loretta Mester. I'm the research director here, and I have the honor of introducing our keynote speaker for today, Franklin Allen. I know that you really are here to hear Franklin, so I'm not going to take that much time to introduce him, but I can't let the opportunity go by to say some things about Franklin. If you look at Franklin Allen's CV, he does some nice things for you, right? He gives you the number of pages, which I believe is like 15 pages. And he also numbers the number of publications he has. So he has 139 published articles, chapters, and books. And if you look at it, and I urge everyone to do so because it is awesome. And I'm using awesome in the old-fashioned way. Awesome, right? It does inspire you, right? You know, it's the quality of what his work is and his work over the years sort of building up a research agenda in financial intermediation and financial stability. He's not a Johnny-come-lately to the financial stability realm. You turn on any television show and everyone became a financial economist after the crisis. Franklin's been working on these things for many, many years. He has a deep understanding and knowledge of the area, and he's done the seminal work in the area, so he's instructed us all, and we all learn a lot by reading his work. The bio is in your booklet. He is currently the Nippon Life Professor of Finance and a Professor of Economics at the Wharton School. He's been on the faculty there since 1980, and he's a co-director with Dick Herring of the Wharton Financial Institutions Center, and currently he's managing editor of the Review of Finance. I mean, again, I urge you to look at the CV, and you can just see the number of things that Franklin has been working on. Not only is he a renowned scholar, a worldwide scholar, he has paired his research with also policy advice. He's an advisor to many central banks and other research centers, which is wonderful. I always think of this, like, if you think about academia, right, there's like three kinds of people. There's the people who just focus on the research and do no service at all. There's the people who really want to do service, like become chair of the department that you want to run away from. You don't want them to be chair of the department. And then there are the people who have a great research agenda and, they're great scholars and they're working in their field, and yet they feel like they should be giving back to their institution and to the profession, taking on professional activities like journal editing. And Franklin is in the latter camp. He's done wonderful work with Wharton, leading their doctoral program and other things. He's been an associate dean and many, many things that he's done sort of to aid the school and also the profession. And just as an illustration of how deep his knowledge is, I remember one of the first times I saw Franklin give a paper. Okay, and this, I'm going to date us because this was before beautiful PowerPoint. This is when there were overheads. Right, and you put your, slides down. And I remember Franklin was really interesting. He put his slide down, and then he used a coin to move down the points in the paper. And I was thinking, wow, this guy really understands the full role of financial instruments in the economy. I mean, that was fantastic. So one thing I want to point out that's not in his bio is that Franklin will be leaving Philadelphia and Wharton School. He's going to take on a new adventure. Going back to his roots, he's going to become the executive director of the newly established Brevin Howard Center for Financial Analysis at the Imperial College London. He's going to be joined there by Douglas Scale, of course, one of his good friends and co-authors, frequent co-author, who will be director of research at the center. And, if you go, again, look at the website for the announcement of that appointment, you'll see that many renowned economists said, how wonderful this was. Larry Summers, Ken Rogoff. I was most impressed that they actually got Boris Johnson, who's the mayor of London, to give a quote about how great it is to bring intellectual capital back to London, and citing Franklin and Douglas for their work. So, Wharton and Philadelphia, we're going to miss Franklin, but of course, we're going to continue reading his work and being inspired by it. So let me ask you to welcome Franklin Allen to the podium.
Thank you, Loretta, for that lovely introduction. And as everybody knows, Loretta is also leaving to become president of the Cleveland Fed, and it's a wonderful thing, but not for Philadelphia. I'd also like to take this opportunity to thank Jalapa for the fantastic work that she did in doing everything in the conference. Most of this conference is about fairly narrowly focused banking regulation. And what I want to do in this talk is to open up the discussion and put that a little bit in context. So I think if you go back before the crisis, there was a widespread agreement that what the central bank should do is focus on inflation. It should target inflation. And some central banks, like the Federal Reserve, also had the mandate of focusing on unemployment. So they had the so-called dual mandate. Financial stability was there in varying degrees, but it was usually viewed as a secondary thing. It's something you needed in order for monetary policy to work, but it wasn't primary. And in many countries, it was hived off into a separate financial services authority or some other kind of entity. In many other countries, the central bank was responsible for it as well. Now, over the years, it's become very well accepted that central banks should be independent because their main role is targeting inflation, and they shouldn't be subject to political pressures as we go through the election cycle. And then fiscal policy was controlled by the government, so by the finance ministry or the treasury, depending on which country you're talking about. Now, clearly, banking regulation went drastically wrong. And I think the basic problem was that the focus was microprudential. So the idea was if banks and financial institutions don't take risks, then there won't be any risk in the financial system, and we will do away with any problems with crisis. And that was a fundamentally flawed view because of systemic risk. And as Charlie was saying yesterday in his keynote, we don't really have a good handle on systemic risk. And I think there are many different kinds of systemic risk, and we need to think very hard about what the different types are. This is a rough categorization that Eleanor Coletti and I have been working on, but it's very incomplete. But let me just go through what I think are some of the main types of systemic risk. The classic view is that they're panics, and this goes back to the famous Friedman and Schwartz book in 1963, where they looked at crises in the late 19th and early 20th century in the US, and what they argued was if you look at the macroeconomic time series, they're flat until you get to the crisis, and then they fall. And so that was a widespread view, particularly among macro people, I think. You had these multiple equilibria, and then you need something like deposit insurance to get rid of them. As long as you've got that, then no problem, and we can solve it. Now, in fact, there are many other types of systemic risk. My former colleague Gary Gorton pointed out that, in fact, you could predict crisis if you looked at leading economic indicators, and he had a very important paper on that. What we now know, I think, is that there are many reasons why you can get banking crises and financial crises in general. If you've got asset prices fall for a whole variety of reasons, and I'll talk more about some of the categorizations in a few minutes, then you can get a financial crisis. Contagion is extremely important, and it's something we know very little about. There are at least three kinds. So there's the kind that Ali was talking about yesterday, which is the domino theory. So if one bank goes down, it can bring another bank, and so on. All the banks that have claims in the chain can come down. And that's a very popular one that central banks use a lot to justify intervention. In the current or the past crisis, the 2007-2009 one, depending on how you think about it, it didn't play too much of a role. There was a little bit of it when Lehman collapsed, and then we had the money market problem. But by and large, it wasn't too big a problem. The second type is where you look at a bank, it fails, and then you look around and say, what are the other banks that look like the one that just failed? And what's that going to do if they fail? And that was a big problem, I think. So if you think about when Lehman failed, Morgan Stanley and Goldman Sachs probably would have failed in that following week if the Fed hadn't given them access to the discount window. So that's also a very important type of contagion. Now, the third type is one that we know least about, but which arguably is the most important. The country that was most affected by the financial crisis was Japan. They had a 10% drop in GDP in the year following Lehman. Now, it wasn't their banks. Their banks were relatively unexposed to the subprime crisis. They kept on lending. They remained fairly well capitalized. So what was it? Well, we don't know really. Why did they have a 10% drop? Some of it was trade, no doubt about that. But 10% is a huge drop. And that is out there as a possibility. They haven't recovered. If you forget about the tsunami and all those things, even before that, they were still well below the peak. And we just don't understand that. Policymakers were terribly worried about that for a year or two after Lehman. But now I think that has sort of receded into the past, but we don't understand that. Financial architecture is very important. We had the triggering of the crisis with the real estate problems and then the subprime problems, and that unleashed a whole set of problems in the plumbing of the financial system. In this crisis, foreign exchange didn't play much of a role, but in many previous ones it has. In the Asian crisis, arguably, it was about foreign exchange. This time, the authorities did a very good job by having the swaps between central banks and so on. Now, typically in finance and in economics, we think about financial risk as being exogenous. So you sit down in Finance 101 and you've got a portfolio and it's a random variable and it's out there, and then you've got to deal with it and have a portfolio. And the same is true about most of the decisions that we make. If we analyze financial institutions or firms under uncertainty, that's how we think about it. And that's part of this micro-prudential view that as long as you keep firms and financial institutions doing responsible things, you don't have a problem in terms of financial stability. So there are some exogenous causes. Wars is one. So, if Russia invades Ukraine, then we may well have a big financial stability problem. For small countries, natural disasters can cause systemic problems. But I think one of the things that we are beginning to appreciate but need to appreciate much more is that a lot of the risk is endogenous. And I'll point to one study here, which I think is extremely important, but I think it's just the tip of the iceberg. And that's this Homeinith, Onjana, Pedro, and Sarina paper, which shows that when you have low interest rates, you get a lot of risk-taking by banks. And that potentially can cause problems. There's many other papers that are beginning to find the same thing. So that's just one example. Now, what I'm going to argue is that if systemic risk and financial stability are actually tied to a whole range of things that the central bank and the government does. And what we need to do is to think about it in a holistic way, and we can't just hive off the different parts in the way that we've traditionally done in the financial architecture. You can't just say, okay, we're going to take care of financial stability with banking regulation. That's not going to be enough. So I think we may actually have to rethink the whole way we think about what central banks do, because it's no longer the case that they're there to just fight inflation. Inflation isn't a problem at the moment, and it probably isn't going to be a problem for some time to come. But financial stability is a big problem, and to deal with that, you need this whole array of policies. So let me talk a little bit about that. So how should the authorities control systemic risk? Well, as I said, it's very complicated. There are lots of things involved in systemic risk. What I'm going to do is just focus on one part of it, because I think this is very important, but that's not to say the others are unimportant. And what financial stability policy requires is to think through a whole array of things. I'm going to focus on asset price falls, because those are very important in many financial crises. They're not the only trigger, but in the majority, probably it comes about because of asset price falls. I've got a categorization here. I'm going to talk mainly about the first four. I think the others are also important, but let me focus on the first four. So real estate is a big driver of financial crises, and there are a lot of papers that document that. This is the Reinhardt-Rogoff table, and this shows the big crises in the last few decades and a few historical ones. And I think it's very important to realize that financial crises happen all the time. Within each particular country, they may only happen every 20 or 30 years, but they, around the world, happen. And since we have so much global connections now, what we're going to see is that probably they're going to have spillovers and bigger effects as we go forward. So what Reinhardt and Rogoff did in their book was to make a very nice case of the importance of real estate, and I agree fully with that. So here we've got the big five in the advanced economies, and this is the decline in real terms of housing prices. You can see Finland minus 50%, so huge drop. Japan started in 1991 and in 2009, and I think you can make the argument still today, although Abenomics may have changed that a little bit, but it's still ongoing. That's 25 years almost. And then some of the other Scandinavian countries and so on. Here we've got the Asian crisis. Hong Kong, very interesting case. They had a drop of almost 60% in real estate prices. Nevertheless, they didn't actually have banking crisis because the banks were very well capitalized. And I think one of the main arguments at a practical level for high capital standards is that example. Now, we had some in the emerging world, Argentina when it defaulted, Colombia, and so on. One of the things that they do in a very interesting way is argue that a great part of the Great Depression was actually real estate. And they look at things like building permits and so on and make that argument. Now, another very interesting one is Norway. And I didn't know much about this until I gave a talk at the Central Bank of the Netherlands. And one of the people there was the vice governor at the Norges Bank. And what he pointed out was this was a huge boom and bust in 1898. They had so much building in the boom that they didn't subsequently build for 25 years. You have to go to the mid-20s to find new buildings in Oslo. So you can see that even today, that there's a whole gap between that. So that's an idea of how important real estate is. The magnitudes of the busts in terms of the fiscal requirements are huge. So this notion in Europe, for example, that you can do it with 55 billion euro is just crazy. Typically, it's 30–40% of GDP when you have these kinds of busts. Now, if we look in the current crisis, I'll focus on three countries which had severe problems. The black line is Ireland, the red line is Spain, and the blue line is the US. We've normalized prices in 1996 to 100, and what you can see is Ireland just had this incredible boom. So prices went up over 300%, and then they halved, basically. That bankrupted the banking system, and because the Treasury in Ireland thought it was a confidence problem in September 2008, they told the government, just guarantee everything, go beyond deposit insurance, just guarantee everything, and the confidence problem will go away and you can forget about it. Now, of course, that wasn't the problem, and this is one of the complications of systemic risk. If it's more than just panics, you've got a big problem because guarantees don't work very well. And you have to be very careful in making them because then the government went bankrupt and the EU had to bail them out. Now, Spain didn't have as much of a rise, went up 200%. They haven't had as much of a fall yet, but that's one of the big issues in the Eurozone is there an overhang. So many people believe that banks are not selling off the properties that they've acquired through the default of property companies and so on. And if they did, the prices would go down, but they won't do that because they would then have to mark them to market, and that would be a big problem. Now, a couple of things to notice here. Real estate's very different from stock markets. We've spent many years documenting in financial economics that stock markets are a random walk to a first approximation. That's not true in real estate prices. Once they get going, they keep on going. There's quite heavy positive serial correlation, both on the way up and on the way down. And that's very important. I think we don't understand that very well at all. But what it means is that once something starts, then it's worthwhile for people to go out and borrow other people's money, invest, because chances are they're going to keep on going up, and that's what we see, and so we get these self-fulfilling bubbles, arguably. But I don't think we understand that process very well. Now, the other thing is, what caused this? I mean, that's the fundamental question. Why did this happen? Was this just some random event that suddenly we got these? Or did government policies, and in particular central bank policies, have anything to do with that? Now, one of the interesting things about these three is that the US, which was the epicenter of the crisis, didn't really have much of a rise in real estate prices for the country as a whole. And so that's another thing that I think is very important. When we talk about stress tests and so on, you feed in these macro numbers, but they don't really mean very much because systemic risk has all these complications of things like contagion and so on. And so even though you don't have too much for the country, you can still have vast effects. Now, of course, what that graph misses is that there's huge regional variation. And you can see that in these graphs. So here we have Los Angeles as the highest. It's more than Spain, not quite as much as Ireland, but more. And then some of the other California places and so on. Now, if you look at this graph, so what happened? Again, we've got this very clear run-up collapse, and now it's running up again. Everybody says, oh, that's good because it's recovering, but maybe we're just going back where we came from. So this graph raises a lot of questions. So supply is clearly important, and there's a lot of work showing that. But if you look at somewhere like Las Vegas is in the middle of the desert. There's no supply problem there. It's not that huge a city. Why did they have such a huge boom? And the various other places you can make that point. Of course, many places didn't have a run-up. You know, Philadelphia, we didn't have much, and we didn't have much of a drop, and many places didn't. So that's a big issue. If you look in Europe, you get some other interesting examples. This is Ireland, what we've talked about. This is Spain, which we've talked about. This is a very interesting country. This is the UK. So UK had a bigger run-up than Spain, and did have a drop that caused some problems, and it ran up. It's not far from the peak now. Is that a bubble? We talk about those crazy bankers in Ireland and Spain, but what about their British counterparts? Is that a bubble? Well, you go to London, everybody says, no, it's different. It's an international center. It's all the money's flowing in, no problem. So yeah, I'm not so sure, but so we'll see. I'll be renting for a while. Now, another very interesting case is Sweden. Sweden is basically at the peak again. Is it a bubble? Well, Stefan Ingves, who did a great deal in the early 90s to solve the problems when he was in the Treasury in Sweden, and then became the IMF troubleshooter for banking crises around the world, he's now the governor of the central bank, and he has very worried about these issues. And so if you look at the public statements that are released of their interest rate setting committee, they go back and forth about exactly what's there. Is this a bubble? Are we going to see a drop in prices or not? Let me give one other example, which I think is very interesting, which is, this is France. France had a, this is France, the brown line. France went up to 250, so not quite as much as Spain, but not far behind. Then it had a slight drop. Now it's back up to the peak. This is Germany. One of the reasons Germany's doing so well is they haven't had a big run up in house prices. And one of the interesting questions is, why are France and Germany so different? France and Germany are not that different in terms of their basic economic structure. They both have sophisticated manufacturing, services, and spatially not that different. And they're both members of the Eurozone, of course, so they have the same interest rates. So what's going on there? I don't think we understand that in the same way we don't understand the regional variation very well. But there is this big question, what happened? Why do we get these very pronounced bubbles? And I think one of the big questions is low interest rates a part of that equation? And my own view is probably yes. If you are in Miami and house prices are rising at 8 to 10%, and there's positive serial correlation, which the Glazer and Jerko study found every dollar it goes up in the US, next year it goes up 71 cents on average. If you're in that kind of positive serial correlation, why not go and borrow? Maybe you can borrow 95 or even 100% and invest, and the price is going to go up in a self-fulfilling way. So that would be my view of how interest rates play a role. The other part is easy availability of credit, and of course that was coming from the Asian central banks, which was supplying trillions and trillions of dollars of credit. Now, the policy community response to this is, okay, we're going to do macroprudential. And what that means is that they're going to interfere in the micro structure of the real estate market. Now, some countries have done that. So if you look at South Korea, they, for example, have loan-to-value ratios which are contingent on house price rises. They have worked for a few months, but fairly soon people figure out a way to get around that. And if you look at the end of the year, they're going up again. There's a very nice paper by Crow, Delarecia, Egan, and Rabenthal at the IMF, and they document a lot of that. My take on that is it's problematic. And if you look at what's happening in China, China's desperately tried to push down prices. They succeeded, then they went up again, now they're going down again. It's very difficult, even with all the degree of control that they have in their banks and in terms of regulation, they're finding it very difficult. Now, some people argue that you should lean against the wind. So this is Claudio Borrio's position at the BIS, and he has a very long history of arguing that, going back to his paper with Philip Blow in the early 2000s. Now, that's a very difficult question, particularly for large countries like the US, the Eurozone, or China, because you may push up rates and pop the property bubble, but you may also cause a recession. For smaller countries, it may be somewhat easier. Now, the other question, I think, is maybe when you're going down with interest rates, you should ask the question, do we really want to do this? What are the effects we're going to have on asset prices? And I think it's important that we realize that low interest rates, quantitative easing, doesn't just affect real estate. I think it affects a whole range of things. So I'll talk more about this, but clearly when interest rates are at historic lows, and the country with the longest history is the Netherlands, the interest rate history goes back roughly 500 years. In 500 years, they've never had such low interest rates, to give you a sense of where we're at. And the problem is that once you go down, you've got to come up at some stage, although it may be very long. And the question is, how's that going to affect things? Now, what we've seen is in the emerging markets, as soon as we start talking about tapering, let alone actually raising them, we start to see turmoil. Now, this is what Brazilian real estate prices have done. Now, if we normalize them here in 2010, they basically, in Rio de Janeiro, they've doubled in a few years, in 3 years. Now, is that because Brazil has wonderful prospects? Probably not, because actually they've been slowing down. Their economy hasn't been doing that well. And you can say, well, Rio's got the World Cup and then the Olympics and so on, but it's not just Rio and Sao Paulo. There's a huge run-up in prices in Brazil. Now, how much of that is due to easy money in the US and the Eurozone and Japan? I would argue that they're probably related. And this is going to cause big financial stability problems in Brazil, which will then speed back potentially to other places. These are stock market prices. Now, this is a very interesting graph to me. This is real prices. So we've normalized what would happen if you invested $1 in 1992. This line is Germany. Okay, German stock market, that's where we should have had money because it's done fantastically well. And with bunds now, 10-year bunds giving 1.56%, maybe that's not so surprising. But what's amazing is these ups and downs. This is extremely volatile. Now, the other interesting line here, I think, is if you said which country's going to grow the fastest over the coming years, I think most people would say China. That's not a very difficult question. If you look back, you said, since 2000, which is the country that's grown fastest? Well, it's China. In fact, GDP has risen by 400% in China since 2000. How's the stock market doing? Well, it's just about to cross Japan to become the worst performing stock market. In real terms, it's exactly where it was 20 years ago. It's the same where it was 10 years ago. They had a run-up and then a collapse. But this is one of China's big problems because that's why people don't have any good place to put their money. Stock market's terrible. And it's a big puzzle as to why that is. But very important for them, and I'll argue important globally in a minute. But one has to wonder, what's going on here? Why do stock prices have these big movements? And if you look at the stock market today, in the US, it's all-time highs, pretty much, just coming up if you do it in real terms, but this is the US. Is that because everything looks great and we're going to have this huge growth? Well, it doesn't seem so, because we're growing at 2%, and we've just been through one of the biggest recessions. Typically, we grow much faster than when we come out of recessions, and we're not. So why is the stock market doing so well? How much does that have to do with quantitative easing? And I think these are big questions because the Greenspan orthodoxy was you don't have to worry about that. And so the usual one is, so when we had the bursting of the bubble in the early 2000s, wasn't a problem. We didn't have a lot of issues there. But you look at Japan, I think it's very instructive. When people lose large amounts of money, and that's what happened in Japan, it's still roughly half of what it was in nominal terms 25 years ago, roughly. They lose confidence. So Japanese people don't invest in the stock market. There's a few rich people that do. By and large, what they do is put their money in banks. And this is the long-term cost of these kinds of movements. Let me give another example. So today, 10-year Italian debt is at 320 basis points. US 10-year debt is 268. So it's about 50 basis point difference. Now, does that make sense? People used to look back when the crisis occurred and Greece defaulted, and they look back and said, so 20 basis points over bunds, what went wrong? And so why do we only have a 50 basis point spread between Italian and US debt? That's quite amazing when you think they've got 135% of GDP in debt. They're back where they were in about 98 in terms of GDP. They haven't grown for 10 to 15 years now. Why is it that their rates are so low? Well, if you read the microstructure of it, banks are out there in Europe buying huge amounts of debt because it's zero weighted in terms of risk. They're bidding up the prices and driving down the yields. And so why is that? Well, we've got Mario Draghi's OMT program, and I think of that as being a limit to arbitrage. Those prices aren't really reflecting the reality of what the market thinks because they know the central bank, if they get out of line, are going to step in and buy huge quantities and restore the spreads. And is that a good thing? I'm not so sure it is because they're taking away the early warning system of judgments of the market. And I think this is, again, an important point. Central banks, together with governments, need to link in a very holistic way about what they do. Rises in interest rates, in my view, are the big systemic risk at the moment. And I'm running out of time, but let me just focus a little bit on Japan. I think Japan is a very extreme example, I would agree with that, but it's a very interesting one if you look at Abenomics. So they have the three arrows. The first arrow is very loose monetary policy. So what the BOJ is trying to do is to get inflation up to 2%. Now, all the kinds of theories we have of interest rates would suggest that it's real interest rates that matter. So if you get 2% inflation from 0 or minus, interest rates should go up. So that would suggest that nominal rates in Japan would go up to something like 2.5%. Now, there's a couple of problems on that. So first of all, it's going to affect the value of banks' assets. If they've got long-term government bonds or they've got mortgages or they've got loans or anything, that's a big problem. The second problem is it's going to have a fiscal effect. They've got huge debt, so 135, 140 in terms of net. The gross is even higher, and we don't know much about what the relationship between the gross and the net holdings are. But a big part of that is the reserves held by the Bank of Japan, and that presumably is pretty short-term things. So their long-term funding costs are going to go up dramatically in terms of the gross requirement. So that's over 230% or so, I believe. So that means 2.5% interest rates. It's going to cost them 5% of GDP to fund the debt in the long run. So that's another problem. The other thing is, well, what happens if interest rates don't rise and you get 2% inflation? Well, the market 10-year JGB rate today is 61 basis points. The markets don't seem to be pricing in inflation. But if we get 2% inflation, negative interest rates, Mrs. Watanabe might decide to take her money overseas and capital flight becomes a problem. This is what the Bank of Japan in their last April's financial stability report did. So they looked at this question. Let me explain these graphs. This is the various components. So this is the loans, this is the bonds, and this is the offsetting on the liabilities side. This is the effect on Tier 1 capital with this ratio of 100 basis point rise. These are the medium and these are the small banks. And what you can see is 100 basis point takes out 40% of Tier 1 capital for Japanese banks that are regional banks, about 35 for the local banks. Major banks, not so much of a problem. They've got rid of this problem to a large extent. It's only going to take out 10. But remember, this is only 100 basis point. We're talking about 200 basis points. So that's going to wreak havoc. Now, was the Bank of Japan worried? Well, this was what they said after. As will be described later, unrealized losses in securities holdings caused by a rise in interest rates will basically not affect the capital adequacy ratios of domestic banks, as the current treatment of exempting these banks from including unrealized losses on security holdings in their capital will become permanent. So that's no problem, guys. We're just not going to let you know about it. But since we know from the financial crisis, the big problem was nowhere knew where the subprime debt was, so all the banks got problems. And again, this is part of the lack of holistic thinking about these issues. Now, as I say, I think Japan is an extreme example, but it illustrates the kind of way that I think you need to think about financial stability. You can't just say, okay, banking regulation, we'll leave that to the central bank or the FSA and then get on with everything else. All the policies affect things. I won't have time to go through all this. Why should global interest rise? Well, if you look in Shanghai or Zhejiang, where the Chinese entrepreneurs are, they're paying 20-25% on loans. Now, you may say, well, that's a risk premium and so on. Well, there's not much default in China. It was headline news the first time a company defaulted recently. Now, what they're doing in the Shanghai Free Trade Zone is experimenting to open up the Chinese financial system. And that's going to change things dramatically. They've got $3.82 trillion in debt. A lot of that's in US treasuries. Now, do they need that? Well, the classic explanation of that is they're helping their exporters. But net trade in China is down to 2.2% of GDP. It's really small. And so they don't need that anymore. And they desperately need funds in China. So this is a big issue, and so there is the potential for interest rates to rise as they open up their financial system. What about inflation? Inflation is not something that anybody worries about very much at the moment, but let me just make one point. Why is it that firms hold so much cash at the moment? This is a long-term trend that's been going on for since 1980, and it's enormous. They could pay off all the debt they have. They could do lots of things on average with this cash. Why are they holding it? That's not in our models, but if they go out and decide to spend it quickly or expectations about inflation change, that's out there. And it's going to be very difficult for central banks to get that liquidity out of the market. Sovereign default, obviously a problem in the Eurozone. So let me just conclude, though. I think the point I'm trying to make is banking regulation is very important. I think microprudential does have a lot to contribute. But systemic risk just changes the game completely. And systemic risk is endogenous. It's very complicated, and governments and central banks need to start thinking very hard about all their actions and how they're going to interact. We can't just do these simple stress tests and things which just look at the single parts of the system. We've got to look at the whole system. As I say, I think Japan is the extreme example of how very difficult it is to think through these things. But I think governments and central banks need to start focusing much more on that. That may require much more coordination within a country and certainly across countries. And so let me stop there. We started a little bit late, so hopefully I've got a chance for one or two questions if people want them to ask anything. Paul.
Professor, I wonder if little Johnny one-notes I asked this question of Charles, and that's the role of the central bank in terms of providing liquidity to the system. Obviously we've seen over the years a little change in how the central bank has intervened, moving more towards kind of asset purchases and being sort of a market maker of last resort. We certainly saw that in the crisis. So my takeaway from your remarks, are that monetary policy is an important contributor to, systemic risks. Could you comment a little bit on the central bank's role as a lender or a market maker of last resort, whether you see that factoring into this dialogue on systemic risk?
So I think that's a very important aspect of what they do. It plays an important role because when we're in a crisis, we're not quite sure what asset prices are going to do going forward. Often it is just a liquidity problem, they recover, but often it's not, and it's very difficult to know how to deal with that. So I think liquidity policies have a role to play, but that's a short-term issue, so it's in the crisis. I think the problem is we're now sort of 7 years after the start of the crisis, and we still have these massive liquidity interventions. And my own view is that that's having a dramatic effect on asset prices, not just in stock markets in developed countries, but on real estate prices in emerging countries, and many other things. And bonds also. I mean, fixed income is a huge part of the asset class. That somebody's going to take losses when those interest rates go up. In Japan, it hasn't happened for 20 years, but then they paid a huge price because their growth, they went from being the fastest growing to the slowest growing, and that's what we're seeing in many developed economies now. So it's very difficult. So I think liquidity is a good short term, but it should be limited to the height of the crisis. Wayne.
So the current Federal Reserve policy is very focused on slack in the labor market. And I would say that my own personal view is that it's sort of an argument that many of the things you brought up as potential concerns about inflation, with asset prices and cash availability and that sort of thing, whether it's reserves in the Chinese central bank or cash in corporations, that in a sense all these arguments are trumped in the macroeconomist mind by the fact that there seems to be evidence of significant slack in the labor market and not much evidence of wage inflation. That in a sense, the argument is that as long as those conditions hold, the volatility in the financial markets is a concern, but it's not going to be able to overcome that in terms of sparking uninflation. What do you think of that argument?
So my own view is that that's the traditional argument, and I think if we were in the world that we were post-war in the 50s and 60s, where you had a recession and then the economy grew at 4 or 5% till you got back to what people thought as full employment, then that's a reasonable argument. But now we're in a world which is very different, which is we have slow growth, and I think keeping these interest rates low has lots of bad things and causes problems. So again, Japan, that was kind of the view there, but now it's for zero interest rates, it's 16 years, I believe 1998, if I'm remembering correctly. It hasn't solved the problems. Their corporations went from being the most competitive in the world to having struggles to survive. If you look at Sony, for example, these long-term rates are problematic. And so, I would agree with you if it looked as though we were going to get back to full employment, but maybe we're already there, because the problem is with 7 years, participation rates have plummeted, and it's not clear these people are going to get back. Now, we may go down to 5%, 4%, but that's a very small amount compared to losing long-term competitiveness, having low growth, and all of those things. And as I said, I think, the problem is that if you mess up the financial system, you're not going to get good long-term growth. And the problem is we don't have small firms that should have been formed in the last 7 years, which would now be growing and be medium-sized and taking on people. So I think it's not just quite as simple as the traditional model had. I think going back, that there was more truth to that, but in the long run, you need a financial system that's healthy, and where the main game in the financial markets is not guessing what the Fed and the central bank is going to do. I mean, it's not what we teach in Finance 101 to go out and find out good firms which are undervalued. It's, well, what's the Fed going to do? What's quantitative easing going to do? This is what finance is largely about at the moment. So that would be my response to that, to what I think is the widely held view in most central banks. Bob.
It seems to me that from a policy perspective, as far as monetary policy is concerned, particularly, your message is less is more. That's correct. on the upside and on the downside.
Right. I mean, I think it would, if you look at Japan today, they've had now 25 years, they're not growing. They're trying to do Abenomics. My own view is that they've got significant chance of it not working. If you look at the third arrow, they've done basically very little. At some point, they're going to have a massive crisis, and then they'll start growing again. And I think you're precisely right. We should do less on the way down. We should do some of the things that Paul was just referring to in terms of, try and make sure that solvent but illiquid institutions don't fail in huge numbers, but don't support things for more than a few months, because it's better to have the recession, maybe have high unemployment, but then if you grow quickly again, it's just a few months and you don't get this problem of people basically dropping out of the labor force that we have at the moment. So yeah, I think markets need to be allowed to work much better than or much more than they currently are. Jim.
Yes, I can. You made the statement that we should expect bigger stimulus effects as we go forward. That seems to be a fairly pessimistic view. I wonder what your view is about the Dodd-Frank Act, whether or not it will work, and in addition, what specific policies you would recommend for the United States today with respect to central bank.
So I think, the Dodd-Frank was much better than I had expected. But as we saw yesterday, there's still a huge amount to do, and it's not at all clear how it'll work. Because again, I think the mindset of the people writing it is very much, it's a bank-by-bank problem. So if you look at the resolution that we had the session on yesterday, I think Dick's point that it might work for one is right on there. But the problem is, in a systemic crisis, it's going to be 2 or 3 in this country, something else in another country. We're not going to know what long-term prices are going to be. It's going to be very difficult to do that without the government stepping in. My basic view in terms of the spillovers, that's part of the globalization, that we've seen it go around the world. The world's much more connected now. In terms of what we should be doing, I think, it's very much what Bob was alluding to, which is we probably should be doing less in terms of this activist intervention, because in the long run, it doesn't do us that good. And we're now in the long run, 7 years after the crisis, and we still have massive problems from it. There's one more question, and I'll stop, sorry.
So you referenced it slightly different time. You referenced stress testing, and you asked if you mentioned that as a prudential mechanism, oversight mechanism. But when you speak to people in the industry that are now sort of applying these models, and a big concern is that there's an increasing concentration in the types of assets that particularly the large institutions, but across the industry, people are holding, driven by Basel and these kinds of frameworks. Do you see a concern long run, for increased systemic risk because everybody's applying sort of the same types of models?
Yeah, that's the herding problem is a big one. So, and that's one of the problems with contagion and so on. So I do see that as a problem. And it's I think that sovereign debt in Europe is a very good example of what you're talking about. The banks are loading up on that, 0.8, but it's not risk-free. And, that's a big problem. So let me stop there. Thank you.